Good afternoon, you're watching Metropole TV and this is Markets Today. My name is Terry Chebet. Now, the Eurobond raised Kenya's public debt to 5.8 trillion shillings. Now, Kenya borrowed an average of 129.5 billion shillings per month over the last 3 months of the 2018-2019 fiscal year. Earlier in 2018, Moody's downgraded the government's issuer based on the observation that as the country's financing needs continue to grow and the government turns to external commercial loans to fund that deficit, more pressure is likely to mount on the government's liquidity and therefore the ability to repay rising liabilities in good time. Now, the credit rating agency, however, retained a stable outlook supported by Kenya's strong and relatively strong economy. Globally accepted debt levels as per the IMF for frontier economies is 50%, that's just 50.0% of GDP. The rising debt levels could result in a debt crisis. That's what economists argue. Possible liquidity pressure could arise from the large government debt instruments maturities, especially the 5-year Eurobond, which was due, of course, earlier this year in 2019. Now, in studio to discuss the issue of Kenya's debt level sustainability is Odhiambo Ramogi, the Managing Director of Elim Capital. Thank you so much for joining us today. Of course, conversations around Kenya's debt issue have reached really, heated spaces where some economists say, the World Bank, the IMF have said, as long as it hasn't touched the 60% level of GDP, then it's not too bad. Where do you stand as we kick off the conversation?
Well, it is bad already. I don't think that I would be in the camp that is saying that as long as it's not yet 60%, it's not yet bad. And I'll give one or two reasons for this. We are a developing economy. We are not as big an economy as Japan, whose debt level is at 119% of GDP. And what that means is that any slight shock will significantly affect our economy. One. And two, ordinarily, some of these countries have a domestic investment community that do not need to go abroad. Mm-hmm. So whether things are good or bad, this community will remain, so to speak, sentimentally attached to their country. A smaller economy like ours depends on the investment community that is international or global in nature. Mm. And these ones usually get very jittery when there are shocks in the economy of a small nation like ourselves. And so in the event that we have a slight hint of debt distress, naturally there will be a lot of capital flight to the bigger economies. But beyond that also there is the principle of net debt. See, a lot of these guys have huge monies for pensions, huge savings set aside. And so that even though the government says that their debt level is at 100%, about 50% of that is the government borrowing from itself. Mm-hmm. And so that the net debt therefore comes down to around even 50%. This is why even the Bretton Woods institutions like the World Bank and the IMF have a different threshold for developing economies like ourselves. Mm-hmm. And they say, look, at 50%, it's all right. Beyond that, it starts to get jittery.
Now, the government argues that, due to the level of infrastructure development that has been taking place over the last couple of years, the only option they had, I'm not sure about only at this point, and perhaps we can take it on just after now, is that they had to borrow to make sure that this infrastructure developments actually take place. Where do you stand in as far as that is concerned?
Well, naturally, so, you have to borrow because if you look at the revenue, and the revenue most of the time is able to take care of the consolidated fund, is also able to take care of the recurrent expenditure, and if you do not borrow, then you will not be able to expand your extra infrastructure in the country. I think the difference in opinion between the professional sector and the government is the cost of borrowing. The cost of these infrastructure projects is very high, and then the return on investment is not there. So then the projects become unsustainable. And I think perhaps we have mentioned this too many times. The ready example is the SGR project that costs billions of shillings, over 500 to date. It's not generating enough to take care of the debt.
I have a concern about that, though. When we look at infrastructure or investments in health, education, infrastructure, are these things that we can really measure in terms of return on investment at this point? And case in point, after debates and debates on international standards, for instance, and one case that comes to mind is the Grand Central Station in New York, which was set up in 1871 thereabout. And from what I see online, what it would cost, or what it did cost in 2013 terms, was $2 billion US. That's in 1871.
Right.
Did they know at that time that it would ever have return on investment? Are we being too careful?
We're not being too careful. Listen, even when you're building a house, you need to ask yourself, am I able to pay the mortgage? And compare buying the house vis-a-vis renting a house, and ask yourself if these two can, what makes more economic sense? And what we are saying is that the projects that they are doing, at least let it give something that is able to take care of the operational cost and pay the debt. We are okay if in the short run it does not make profits, just break even. And this is not happening.
But should we look at a public infrastructure from a profitable perspective?
No, but we should look at it from a sustainability perspective. Okay. And that's why I'm saying let it be able to carry its weight. Because now it's eating into the public budget, where we need money for health, where we need money for education and other amenities to the public. And the worst part also is that they always opt for the expensive option compared to the cheaper option. Because even long before we started investing in something like the SGR, there were suggestions that we can improve the meter gauge railway and it can still function well, it can do much better. Certainly because our traffic in terms of the containers that we bring in is not so high. And this is especially the case because most of the transit is imports. Our exports make for around 2% of the traffic. And so this is why we were suggesting that the World Bank idea would have worked much better. And it was like 10% of the cost. So that this money now can be invested in where we actually need it, like now the LAPSSET project really needed this investment as opposed to Mombasa, Nairobi. And so this is where the difference of opinion is with the government. Okay.
Let's talk about China, which is of course another sticky point, and as far as Kenya's debt level is concerned, and the fact that this no strings attached relationship then makes it easy for the Kenyan government to go directly to China and not necessarily other partners like the Bretton Woods institutions, for instance. How do you see that relationship going and faring vis-a-vis the performance of Kenya's economy? Are we taking that carrot too quickly?
Sadly, I think we already did.
We swallowed the carrot.
We already did. Listen, one of the key differences in terms of the public finance management between the Uhuru administration and the Kibaki administration is that Kibaki was a bit more conservative. There's something we call the concessionary debts that you get at concessionary rates, which are way below the market rates, and you can negotiate them for a longer period of time. And Kibaki loved these ones because they were very favorable to the country, where we were economically, and it helped to stabilize the country. But now the Chinese prefer commercial debts for two reasons. they are more profitable to them, and they are in the business of lending money. They are your typical global Shylock. And the other thing also is...
That's a strong word to use.
No, for real. The other thing also is there's a way in which if a good percentage of a country's debt is from one party, you have a significant amount of control in that country. They cede a level of sovereignty to you. It might not be legal, but it is indeed economic. And China wants that because they're interested in natural resources in the country. They're interested in the natural resources in the region. And so they want to take advantage of the infrastructure within the country. And so it is indeed a catch-22 in terms of our relationship with the Chinese. I would prefer that we go for the concessionary debts arranged between multilateral or bilateral parties. They are usually much better to manage. Yeah.
How about domestically? And you did touch on this earlier in reference to other economies out there that can afford to borrow internally at such high levels, which would take it up to 100% of GDP. Japan, which you mentioned, for instance. What options do we have as Kenya if we look at our local debt markets? Is there somewhere else within our local markets that the government can still tap into?
First and foremost, I think we as a people also need to improve our savings culture. The Chinese have the opposite problem, which is the Chinese save too much. And so a few years back, the government set out to try and give them a sense of consumerism, because that helps too.
There is such a thing as saving too much.
Yes,
wow.
Because they were not consuming. So you have a very rich economy in terms of production, but you need to export almost everything because the local economy is not consuming as much. And so that means that the mobility of money, the velocity of money is significantly reduced. But now here we have the opposite. We spend a lot. We do not save as much. Most of the middle class guys, if they were to, for instance, lose their jobs, cannot survive for more than 3 months with the same level of lifestyle. And this worries because when you save, then that savings can be used to finance government operations through buying of bills and bonds, either by the banks or the NSSF or something like that. But now that we are here, the other option would be a better fiscal management policy, which is, do we really need to spend on this at this time? Can we have some austerity, mild or extreme at this time? I would recommend mild because we are not yet in the danger zone, but we are heading there at a very fast pace. And austerity simply means that we reduce government expenditure, and so that we reduce the deficits to less than 5% of budget. And this will significantly improve our debt portfolio. Now, there's the political angle of it, which is the debt ceiling.
Yes, the recent news.
Yes. Sadly, I think it's more of a political tool because there is no evidence that the debt ceiling really helps to manage debt or that it helps to contain public expenditure. Governments simply spend like it doesn't exist, and when they reach the limit, or they go to parliament, you know what, you either push this thing up or we are looking at a constitutional crisis or a financial crisis. And because parliament is responsible, they will push it up. And you know, there are many countries in the West that don't have the debt ceiling, and they're not doing badly, like Sweden and the UK and France. They're not, I mean, even Germany doesn't have a debt ceiling. The guys with the debt ceiling, and they keep pushing it, the Danes and the Americans. And so it's more of a political tool to give Parliament a voice into the whole process of debt management. But as an economic tool, it hasn't succeeded elsewhere. And I would not recommend that we put a lot of emphasis there.
On that, okay. Let's touch on the capital markets a little bit, and because this, in a sense, does touch on the depth or lack of thereof of our capital markets. Because, you know, if we were at a certain level of depth, then it would be an option in terms of how the government borrows today.
Certainly.
What would you recommend, or what are your thoughts around deepening the capital markets and making that an avenue for government to borrow?
Well, there are usually two dangers when the government goes into a lot of borrowing, especially from the private sector. There's something we call crowding out, and perhaps this has been observed when you saw
the interest rate caps.
Yes, the interest rate caps. The banks were giving government money and denying us, the smaller players, money. When you again go into the capital markets and you say that the government comes to the capital markets to borrow money, but you see at any given time it is either the government or the private sector competing for money. It's usually either the shares or the bonds. And I go there and I ask myself, all right, the bonds are more stable. I'm sure I'll be getting some income. I'm sure that after all this is done, I will be having some money. However, the return profile is low. The shares, very unstable, but I will get something significant. And so this gives the shares an opportunity. However, if government were to go into the stock market aggressively and perhaps raise the interest rates and make it too attractive, they might make the shares side of things a bit unattractive. And so yes, deepening the stock market is a great idea, but it must also be tethered or leveraged to a point where government does not make the investors to shift all their focus to bonds and bills.
All right. Let's flip the coin a little bit and look at what's happening across the African region in as far as debt distress is concerned. Angola, South Sudan, Chad, and of course these are economies that have been, you know, stressed through many things, including war from time to time. But as our public debt continues to rise and you know, economies continue to signal the red flag, are we facing a risk at any one point from a debt distress level?
The risk is there. The risk is there. I mean, before the Greek crisis, after the recession of 2009, many people thought, come on, governments really cannot go broke. When you see yourself going broke, what you do is you just go print more money and you're good. Then we realized governments can go broke. And so the issue of debt management became a key economic issue of discussion, both at the national level and internationally. Where we are right now in terms of the African countries, and interestingly, most of them are indebted to China. And you'll find that anytime you look at their accounts, the major attraction for China is either the oil or the natural resources. We do not have that sort of anchoring because our oil has not yet been exploited significantly or explored significantly for us to say, therefore, that this will be able to pay our debt for the next 5 years. And so we are indeed facing a challenge in terms of, listen, this might happen. We might get to a debt distress level. And that's why there are calls for the government to manage its deficits. Yeah.
What is your opinion on the best way forward? You know, as we wind up, it's clearly getting to levels where economists are saying, okay, is government not seeing the same things we are seeing? What's the way forward?
I think for us, the bigger challenge is someone is experimenting with our economy. It's an interesting experiment, really.
Who is this experimenting with our economy?
I will
name and shame.
I will be careful not to. But it's a very interesting experiment. Listen, I wish I was not affected, because then I would watch from afar, perhaps with even popcorns, and enjoy the experiment. But sadly, I'm affected like around 48 million other Kenyans. And the question that this person is asking is, how far is too far? How far can we go with this thing until it breaks? What's the elasticity of this country's resilience, economic resilience? Because we are borrowing very fast. We are investing the money in projects that are not spurring growth. They are supporting projects like roads and rail. It's not like a project that, after investing in this, then there will be. You see, if we invested in a refinery somewhere in Turkana, then you're sure after a while we are good. So we are investing in supporting projects. Our deficit levels are growing every now and then. And so it's more of an experiment of how far we can go. It's a beautiful experiment. As an economy student, I'd love to observe how far it goes. But the sad part is I am affected by it. And so I have to make noise every now and then and tell them, listen, guys, please reduce the deficit, please reduce the debt. And I think that would still remain the clarion call. Let's reduce the debt. I would not be overly concerned about Parliament having their fun in the process by increasing the debt ceiling, but I would be concerned by Treasury's actions towards debt management.
Wow, thank you. Thank you so much, Odhiambo, for sharing your insights with us. I mean, it's quite interesting, the analogy you say about somebody experimenting with our economy, especially given the fact that the people who are possibly experimenting are economists and former ministers of finance. And that's it for Markets today. My name is Terry Anchebet. In studio we had William Odhiambo Ramogi. Keep watching Metropole TV. Have a good afternoon.